What's up, everybody? Welcome back to Entrepreneurial Edge, the channel dedicated to helping you build wealth and achieve financial freedom. But here's the thing. Successful investors, they don't just survive market downturns, they use them to their advantage. That's what we're diving into today. We're breaking down 15 powerful strategies to not just weather the storm, but to actually thrive when the market takes a dip. Make sure to like this video and subscribe to our channel for more insightful content. Look, I get it, buying when everyone else is freaking out can feel counterintuitive. But think about it, when prices drop, it's like everything's on sale, right? You get to buy your favorite companies at a discount. But, and this is a big but, you gotta be smart about it. Remember the 08 crash? A lot of people thought it was over, jumped back in too soon, and got burned by the dead cat bounce. Do your research, understand the companies you're investing in, and be prepared to hold for the long haul. We've all been there, right? The market tanks, your portfolio's bleeding red, and suddenly you're questioning every financial decision you've ever made. But here's the thing. Panic selling is the absolute worst thing you can do. When you make decisions based on fear, you almost always end up locking in losses and missing out on potential gains. Instead of hitting the sell button every time the market dips, take a step back, breathe, and remember your long-term goals. This is a marathon, not a sprint. Now, I'm not saying you should go full-on doomsday prepper and bury a treasure chest of cash in your backyard, but having a cash cushion, say 15 to 20% of your portfolio, can be a lifesaver when the market throws a curveball. Plus, it puts you in a prime position to buy those dip opportunities we talked about earlier. Remember, cash flow is key, especially when things get volatile. Dollar cost averaging, your secret weapon. Trying to time the market perfectly is like trying to catch lightning in a bottle. It's practically impossible. That's where dollar cost averaging comes in. This strategy is all about consistency. You invest a fixed amount at regular intervals, regardless of what the market's doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Level up your career, recession or not. Look, I'm not going to sugarcoat it. Economic downturns can lead to job insecurity. But here's the good news. You have the power to control your own destiny. Now's the time to invest in yourself. Take those online courses, learn new skills, and become an indispensable asset to your company. Remember, a recession can be a chance to reposition yourself for even greater success. Strategic selling, it's not about panic. Now, I know I said earlier that panic selling is a big no-no, and it is. But that doesn't mean you should hold on to every single investment no matter what. Sometimes it makes sense to trim the fat, to sell off those underperforming assets that are dragging down your portfolio. The key here is to be strategic, not emotional. Let's be real, the financial news can be a bit of a circus, especially during a market downturn. It's all doom and gloom headlines designed to scare you into making rash decisions. My advice? Tune it out. Seriously, limit your exposure to the financial media and focus on your long-term plan. Don't let their noise distract you from your goals. One of the best ways to weather a financial storm is to diversify your income streams. And guess what? The gig economy is booming. Whether you're a writer, a designer, a programmer, or anything in between, there are countless opportunities to earn extra income online. This could be anything from freelancing to starting an online business to driving for a ride-sharing service. Explore your options and create multiple streams of income. You've probably heard this a million times, but it's worth repeating. Diversification is key to mitigating risk. Don't put all your money in stocks. Spread it across different asset classes like bonds, real estate, commodities, and even alternative investments like art or collectibles. This way, if one asset class takes a hit, your entire portfolio won't go down with it. Think of your investment portfolio like a garden. You need to tend to it regularly to make sure it's growing in the right direction. That's where rebalancing comes in. Over time, some investments may outperform others, throwing your original asset allocation out of whack. Rebalancing involves selling some of your winners and buying more of your losers to bring your portfolio back to your desired risk level. When the economy takes a downturn, certain sectors tend to hold up better than others. Think consumer staples, things people always need like food, beverages, and household products. Or healthcare because people still get sick, even during a recession. Adding some defensive stocks to your portfolio can help cushion the blow when the market gets rough. Look, I'm all about finding great deals, but when it comes to investing, quality matters. Don't just buy any stock because it's cheap. Focus on companies with strong fundamentals, solid track records, and a competitive edge. These are the companies that are more likely to weather economic storms and come out stronger on the other side. Choose companies you believe in for the long haul. Never stop learning. Knowledge is power. The financial world is constantly evolving, so it's crucial to stay ahead of the curve. Read books, listen to podcasts, take online courses, and follow reputable financial experts. The more you learn about investing, economics, and market trends, the better equipped you'll be to make informed decisions. Don't be afraid to seek professional help. Hey, even the most experienced investors rely on experts from time to time. If you're feeling overwhelmed or unsure about your investment strategy, don't hesitate to consult a financial advisor. A good advisor can provide personalized guidance, help you create a plan tailored to your goals, and hold you accountable. Seeking professional help can make a world of difference. Long-term vision, ride the waves. The market is like a roller coaster. It has its ups and downs, its twists and turns. But here's the thing. Over the long term, the market has always trended upwards. So when the market takes a dip, don't panic. Remember your long-term goals, stay the course and ride the waves. Stay focused, stay disciplined, and you'll come out ahead in the end. Thrive in any market. So there you have it, 15 strategies to not just survive, but thrive when the market takes a dip. Remember, downturns are a natural part of the economic cycle. If you found these strategies helpful, hit that like button and subscribe to the channel for more videos on building wealth and achieving financial freedom. Until next time, stay focused, stay informed, and keep crushing it.